Your lender said that the appraisal is a big deal, but why? How does it work? The appraisal is a very important step in the mortgage process, so let's talk about how appraisals work and how they can impact your mortgage. So what is an appraisal? An appraisal is like an expert opinion on the value of the property that you're buying. It's a detailed assessment of the home's condition, features, and location. Lenders require appraisals to ensure that the value of the property is at least equal to what you're paying for it. This step in the process protects both you and the lender, ensuring that you're not overpaying for the property that you're buying. Let's walk through the appraisal process step by step. First, the lender orders an appraisal from an independent licensed appraiser. The appraiser visits the property, assesses its size, condition, and layout, and then compares it to similar homes in the area that have sold recently. The appraiser considers factors like recent sales, market trends, and the property's unique features. Now let's talk about how appraisals directly impact your mortgage. The appraised value helps to determine how much the lender is willing to lend you. If the appraisal comes in at or above the purchase price, then you're on track. However, if the appraisal is lower than expected, it can create some challenges. Typically, the lender will use the lesser of the purchase price or the appraised value to determine how much money they will lend you. So let's say you're able to finance 100% of the purchase price, for example, and the appraised value is $10,000 less than what you expected it to be. That means that the maximum amount that the mortgage lender will lend you is now $10,000 less, so you're short $10,000 essentially. So what happens if your appraisal is short? Well, the good news is that there may be different options that you can explore to help make up that difference, one of which is an appraisal contingency clause that is usually in your contract, not all the time, especially in a tough market, but it can be in your contract, which would allow you to negotiate with the seller so that basically what you're saying is the home is not worth what you've agreed to sell it to me for and what I've agreed to buy it for. However, in our contract, we've agreed that if that were to happen, you would reduce the purchase price to match the appraised value or split the difference or just renegotiate the terms of the contract. This way, you don't have to run the risk of backing out of the deal and possibly losing your earnest money deposit with the seller or buying a property that's not worth what you're paying for it for. So in short, the appraisal is a process used by mortgage lenders and home buyers to determine that the value of the home being purchased by comparing it to homes and recently sold homes in the area is equal to what you're paying for it for, so that you're not overpaying for the property. If you have any questions, feel free to reach out to me. Mortgages are complex, so let me give you the tools you need to make the right financial decisions. Thanks for watching.